Right, today we're going to look at taxes and healthcare. We are going to need our calculators out, and you'll need a separate sheet of paper at one point in the presentation. A lot of this, I'm just going to share different things about taxes and healthcare, but we are going to do one activity in the middle where we calculate the take-home pay of someone with a certain salary. So we will need that separate sheet of paper for that. So we'll give you a minute now. And if you need a calculator, be sure to ask the sub to get you one from the drawer. And make sure to give it back at the end of the period. Okay, so what are the different things that will affect the bottom line of your money that you get to take home when you're a young adult? So when you get your paycheck, you'll see things like federal tax taken out, state tax taken out. Those are progressive taxes, which we'll see in the upcoming slides. FICA, we'll see on your paycheck, which goes to Social Security. You get 6.2% of your income taken out until you start making 142,800. Anything beyond that, then you don't get additional taken out for Social Security. And Medicare is 1.45% of your income. Now, also, you'll have health insurance. Um, there's a common misconception of young people that think you just automatically get health insurance for free. There's parts of it that you have to pay, and that's one of the things we'll look at in today's video. And one of those is you pay part of the for part of the plan, and your employer pays for part of it. So those are called premiums. And then if you took out student loans, those will have to start being paid once you graduate. You're accruing interest on that, and you've got to start paying down those loans. So first off, why do we pay taxes? So federal taxes go to things like Social Security, defense, Medicare and Medicaid, and among other things. State taxes over on the right there, a big chunk is for education and healthcare. You have higher education, um, mental hygiene, transportation. And then at the local level, a lot of the taxes go towards public schools, maintaining local roads and parks, paying for government officials, and a big tax also is for police and fire protection, their local government salaries as well, and then also libraries. Most federal taxes come from income tax. State taxes come from both income tax and sales tax. And then your local taxes, you get some sales tax, and then a big chunk of it is from property taxes. You don't pay property tax if you're a renter, but it is factored into your rent because your landlord is having to pay that property tax. So basically, they pass that tax off onto their tenants. So these are called tax tables. They're the different tax brackets. Um, Notice there's different ways you can file your taxes. You can file as a single filer, a married person that files jointly, married but filing separately, and so on. For the activity we're going to do today, we're going to look at filing as a single filer. Now, in general, notice that the percentages go up. So if we look at the single filer column, the first $11,000 you make is only taxed at 10%. But then from $11,001 to $44,725, those are then taxed at a higher percentage at 12%. And then each chunk of money you make additionally in the different brackets gets taxed more and more. So notice if you're making over that last amount, you're getting taxed 37%. So if like you're a multimillionaire, the majority of your money is being taxed at that highest rate at the 37%. We'll come back and talk about what's meant by standard deduction and everything in a second. These are the state income taxes. Notice the percentages are a bit smaller, and the numbers of the intervals are smaller as well. And what we're going to do in our scenario is just so we can have several tax brackets come into play, we're going to take someone with a salary of $120,000 filing single and see what's their actual take home that year from that $120,000 after all the different taxes that you have to pay. So first thing we're going to figure out, which I have down here, are FICA and Medicare. So notice that 120,000 is below the 142,800. So the FICA and Medicare, they get calculated off of that 120,000. So what we're going to do first with our calculators and our separate sheet of paper, we're going to take that 120,000 and we're going to multiply it by 6.2% as a decimal. So we'll have 0.062. And then we'll do the 120,000 times 0.0145. So take a moment to put each of those in, and those are the simplest tax amounts that we'll figure out. So we should get $7,440 taken out for Social Security and $1,740 taken out for Medicare. So next up, let's talk about what a standard deduction is. So in both your federal and state taxes, they allow you to take what's called a standard deduction, and that reduces your um, taxable amount. So no one's paying in the tax tables 100 off of 120,000 if you made 120,000. Everyone's able to reduce by at least for the federal 13,850. Now there are things called itemizing your deductions. So say you give lots and lots of money to charities, you can itemize like those donations that you make, and if all those itemized deductions add up to more than the standard deduction, then you would take that off. With the two new tax laws that went into effect, it's probably been a bit now, so like in the late 2000 teens, the standard deduction became larger, so it became more likely that people would take the standard deduction. So for our case, for the federal, 120,000 minus the 13,850 would give us 106,150. That's how much we're getting taxed off of, that much of our income. So what I've got broken down in the colors there is that first 11,000 that we make, that's going to get taxed at 10%. Then the next chunk in the 12% bracket is all the money that from 11,000 to 44725. So that's 33,725. And then we've got the other chunks as well. Now the reason that green chunk at the end is not as much money is that bracket really went up to $182,100, but we just didn't make that much money. So it's just that leftover beyond the 95,375. Okay, so in order to calculate this, we're going to take the 11,000 and multiply it by 0.10. Then we're going to add to that the 33,725 and multiply that by 0.12. Then we're going to add to that the 50,650 and we're going to multiply that by 0.22. We're going to add to that the 10,775 and multiply that by 0.24. And what that's going to give us is the total federal tax that we have to pay. So take a couple minutes, see if you can put that all in your calculator and see what you get. So when I multiply that out, assuming I typed it in correctly, I got $18,876 for our federal tax. So what we're going to do now is we'll go over to the state table. Now the state standard deduction is different. State standard deduction is $8,000. So if we take that away from the $120,000, that means we're going to get taxed by the state off of $112,000. I've broken it down in the colors there. So the first 8,500 is getting taxed at 4%. Then the next 3,200 is getting taxed at 4.5%, and so on. So for the state tax, we're going to have 8,500 times 0.04 plus 3,200 times 0.045 plus 2,200 times 0.0525 plus 66,750 times 0.055, and then we'll have plus the last 31,350 times 0.06. So I'm just taking those numbers in each of the boxes times the percentages above. So we'll give you a little bit of time, see if you can punch that in your calculator to get the state tax. So I got for that $6,151.75. So if we bring that over here, that was our state amount. So what we're going to do to figure out our take count pay, we'll take that 120,000 we made, subtract off our FICA, the 7440. We'll subtract off the Medicare, the 1740. We'll subtract off the federal, the 18,876, and we'll subtract off the state, the 6151.75. And we'll see what we get for our take-home pay. So we should end up getting $85,792.25. Now, just to see roughly what that is, if you were to divide that by 120,000 to see what percentage you actually get to take home, it ends up being 0.7149 and change. So you take home about 71.49% of your salary. That's your take-home dollar amount, and you're taking home about 71% of it. So overall, you ended up losing like 28.5% of what you made. So that exercise was just intended to show you, to give you an idea of like what's happening with your taxes, how it comes out, everything like that. So we talked about the standard deduction. You would only itemize your deductions if it was going to come out to more than that. Some things that you can um, itemize are like charitable contributions and things like that. So charities actually did not like it when in the new tax laws the standard deduction went up because that made it less likely that people would maybe donate a lot of money for the tax write-offs. So, what does it mean to be tax deductible? Um, Certain expenses are tax deductible. So, like I said, charitable contributions, retirement contributions that already had tax taken out. So, like if you had an IRA or a Roth IRA, student loan interest up to $2,500, interest on your home mortgage, which is not capped, healthcare costs, and then property taxes capped at $10,000. Um, why are some deductible, not others? Well, those are things that had to be lobbied for through legislation. And there's also fixed tax credits for dependents. So like there's a for each child you have, you get a certain amount off your taxes as well as a tax credit. So you can play some games with the tax rules to make it as advantageous for you as possible. So like for example, in my own personal life, when I got married, my wife had a ton of student loans, enough that her yearly interest that she was paying on the student loans was more than $2,500. Well, we also had a house where we had paid down a certain amount of the mortgage. So what we were able to do is take out a home equity loan, which is like taking out a second mortgage on your house, and just using that to pay off the student loans. So now all of the interest we were paying was mortgage interest rather than some mortgage interest and some student loan interest. And the reason that was advantageous is all of that interest we could now deduct off of our taxes because it was from a mortgage and not from a student loan. So there are things like that that you can try and do to make it advantageous for you within what the tax laws tell you. And an accountant can help you work through that stuff to make it the best situation possible for you. So filing your income taxes. Basically, you have to you get your W-2 form and any other earning statements from like bank accounts, stocks, things like that. Usually it's by February 1st that they are required to give you those things. And then basically it's up to you to calculate and tell the government what you were supposed to pay in taxes. And as it's been taken out during the year, if you overpaid, you get a refund. If you underpaid, then you have to pay them more. There's tutorials of how you can do this online. There's things like TurboTax and stuff like that can walk you through it. That are paid things, or you can hire an accountant to do it for you. Now, how do you find someone reliable to do your taxes? Best thing to do is just ask around. Ask your friends, people that you trust, who if they've used someone, and they could give you firsthand knowledge of whether they were good to work with, whether they liked the job they did, and things like that. Now, how does IRS know if the things you're claiming deductions are legitimate? Well, they audit a certain percentage of tax returns that come in, and what they're probably looking for are irregularities, red flags. They probably have computer systems that, based on the claims, certain ones get flagged, and then they look at those more closely. So, as an example, I had a friend once that in one calendar year, he won $5,000 in a fantasy fishing competition. And then he also, in an actual like fishing tournament, he was in like the Bassmasters tournament that was on Oneida Lake, and he won a division of that and won a boat and a trailer that was valued at like $35,000. So he had to claim both those things on his taxes, and they're both in the same year. Well, these were irregularities compared to all the other tax returns he'd ever filed. So sure enough, that year he got audited by the IRS because they wanted to see, okay, is this legitimate? This stuff just came out of nowhere. It's not similar to any of his other tax returns. All right, next we're going to talk about insurance. So there's several different types of insurance, and you can see them listed there. If you have your driver's license, you're probably already paying auto insurance. Hopefully you are. Um, Health insurance is through your parents right now. One of the ones I want to point out that you should consider getting in the near future in your life is renter's insurance. So many of you might be going to college next year. You might be living in dorms to start out, but eventually you might move off campus and you might rent an apartment or a portion of a house or something like that. I would strongly suggest to get renter's insurance. Say you're renting an apartment and someone in the apartment next door leaves the stove on and the whole apartment burns down. Well, if you don't have renter's insurance, you're out of luck. So get renter's insurance. If you have a roommate that leaves the door open and all your stuff gets robbed, you're out of luck. Make sure you have renter's insurance so that it can cover things like that. So what is health insurance? So health insurance is a plan that helps share the risk of high medical costs, and it reduces the individual risk by spreading it among a lot of people. So you make premium payments, you and usually your employer if you have it through your employer, and then the insurance promises to pay all or part of the medical expenses that come through. So the idea is to protect people from financial ruin, from enormous bills from doctors, hospitals, things like that. So about 12% of people are uninsured. 80% of uninsured people come from families that are working. Younger people are the most likely people to not have health insurance because they feel they don't need it because they're healthy and things like that. So group insurance. Uh, a lot of people get their insurance through their employer, and this would be considered group insurance. Groups are able to negotiate better coverage, often lower premiums. Employers pay for a portion of the insurance, then often the employee has to kick in some of the premium. There's no exam required. Down at the bottom there, you get the benefits of COBRA if you change employers. So what's meant by that? Say you're switching jobs, but there's like a 6 week gap in between your two jobs. Well, you don't want to go that 6 weeks without health insurance. What if you get in an accident? You have to go to the hospital or something. So what you can do is you can pay a little bit to get what's called a COBRA plan. And what that does is it allows you to keep your health benefits from your previous job for a certain period of time until the health insurance for your next job kicks in. Another thing that can be helpful is what's called a flex spending plan. Like in our district, we have that. You can use that to set aside money pre-taxed to either go towards health expenses, or they also have them for paying for like childcare and things like that. So that's something to look into when you get your first job. If you know you're going to have a certain number of like daycare expenses, or if you know you have regular health expenses, you can use the flex spending plan to have that go as pre-taxed money. Individual insurance. Um, Many people these days get individual through insurance through the Affordable Care Act. So you go to healthcare.gov and it lists the different plans that are available, what the different prices are, and you basically are able to shop for your insurance. So the real cost of medical and dental insurance. So first off, you pay the premium, and that's the cost of the policy itself. An employer usually kicks in some of this. Then in a plan, there's a deductible. What this is you need to pay a certain amount before the insurance actually kicks in. Could be a smaller amount. It varies from plan to uh, plan. A copayment is something that you have to pay each time you go to the doctor's office. So those essentially are intended to help discourage you from going to the doctor when you don't really need to. It's basically saying, okay, yeah, we're going to cover most of this, but you've got to pitch in a little bit if you're going to be going to the doctor all these times. I think there's one more thing on this. Yes, stop loss prevention. So insurance plans also have what's called an out-of-pocket maximum, where if in a calendar year you from like copays and deductibles and all that, if you pay a certain amount, any beyond that you would not have to pay. So say you're going to have some huge major surgery, you for that surgery, if you have the health care and it's under your coverage, then there's no way you would pay for it more than what your maximum is. And usually it's a couple $1,000s or something like that. There's government programs that some people get their health insurance through. So Medicaid is for low-income families or people with limited resources or disabilities. Medicare is for people that are 65 and older, and you can get Medigap insurance to cover the difference between what Medicare covers and other um, things that you might want covered. The last main thing I want to point out here in this video is the differences in what employers pay and what the individual pays. So this is some data from almost a little while ago. So it's from 2015. So employers in general paid 83% for single coverage. Small employers tend to pay less. Family coverage costs a lot more. So notice in this one, a single health insurance policy was 6,251. On average, employers paid 83% of that, but a family policy cost 17,545 when this was surveyed, and the company on average was covering 72% of that. So reason family costs so much more is, say, within the that's basically the family policy has to cover families that may just have two, all the way up to families that might have 10, 12 people. So that kind of has to balance out, and that's why it costs such a significant amount more than the single. I remember when I got married, um, my wife went on my insurance, and over the weekend that I got married, my paycheck went down a ton because my health insurance policy then changed from a single health insurance policy to a family one. Smaller employers generally pay a little bit less overall. So you have 85% for a single, 65% for a family, and that's just because it's not spread out among as many people in like a larger company. And the different things that determine your insurance premiums, what your different risk factors. So like for example, for car insurance, um, the younger you are, the more risky you are for the insurance company, so you're going to have a higher premium. If you've had accidents before, things like that. Um, if your deductible is higher, usually your premiums will be a little bit less. If your deduction is lower, your premiums could be a bit higher. The big ones that you want to make sure you have are renters or homeowners insurance, auto, health insurance, and then currently people can stay on their parents' health insurance till 26. And then after that, you would have to get your own either through the healthcare marketplace or through your employer. So I hope this video helped inform you a little bit more about taxes and healthcare. And there's no homework or anything that you have to do as a result of this video.